Hi guys, welcome to our recording for week 2. I hope that you're able to undertake some of the activities for week 1, and I hope that worked out quite well for you. If you've got any questions, of course, just keep in touch. Now I'm just going to share my screen. Done that, and then I'm going to bring up the slides. And today we're going to be talking about recording transactions, because that's what an accountant does. Okay, so we're up to week 2, as we said, and we want to talk about recording transactions. So we'll go through the slides, and then there's of course going to be the opportunity that you can try to do some of the questions during the week, and then I'll make the answers available. Okay, so before we begin, would you please go to YouTube and watch the following video? It's 8 minutes long. It's really good. I suggest you have a look at that. It's called the accounting equation. Okay, you can see it there. Definitely worth watching. Explains a lot to you in terms of how we account for a lot of our transactions. Okay, so please watch that. I won't watch it with you. I'll get you to watch that, and you can go through it slowly to get a better understanding of what we're doing. All right, so a couple of equations that we often use. Now, in our last lecture, we talked about the accounting equation. We said that assets minus liabilities is equal to owner's equity, or we said that net assets is equal to owner's equity. We can change that around a bit and say that assets are equal to liabilities plus owner's equity. Okay, now that's the accounting equation, the balance sheet equation. Okay, there is also another one that says that profit is equal to revenue minus expenses. Okay, and at the end of the financial year, the profit is either distributed to the owners through dividends, or we keep it in the business because we might want to use that money in the future to maybe make an asset purchase. And when we keep it through the business, that money is transferred to the statement of financial position, or what we call the balance sheet. Where does it end up in the balance sheet? Well, it ends up in owner's equity, because those profits, they belong to the owner. All right, so assets is equal to liabilities plus owner's equity plus profit, like I just said. So we've expanded our accounting equation. We also know that profit is equal to revenue minus expenses. So if we substitute profit for revenue minus expenses, we can say that assets equals liabilities plus owner's equity plus revenue minus expenses. And another way of saying that, by kind of rejigging our formula, is to say that assets plus expenses is equal to liabilities plus owner's equity plus revenue. Okay. Now, whenever we do anything in accounting, we've got to make sure that this equation balances. So if this left side goes up by 10, the right side also has to go up by 10. We can't have it unbalanced. If it's unbalanced, we made a mistake. Okay. All right. So every transaction, therefore, must affect at least 2 accounts. Okay, so if I go back, you might have assets going up in terms of a machine, cash going down in terms of paying cash for it, but that's okay, because we've seen 2 impacts, and that's what we're after. Okay, or if we sell something, we might see revenue go up because we sold some jelly beans at our shop, but we might see assets go up because we've received cash for selling the jelly beans. Now, the accounting equation transaction must remain in balance at all times, okay? Now, it says here the sum of all debits must equal the sum of all credits. Now, people get a bit worried about this, but nothing to worry about. Assets and expenses, they're brothers. Liabilities, owners, and equity and revenue, they're sisters, okay? Or vice versa, doesn't matter. So what this means, if you want to increase an asset or an expense, we use the term debit. If you want to decrease it, we use the term credit. These three here, liabilities, owner's equity, and revenue. If you want to increase them, you do the opposite. It's a credit. If you want to decrease them, it's a debit, okay? So, come back here. A business pays wages of $20,000 to its employees. The effect on the accounting equation will be, we're going to decrease assets, called bank, and we're going to increase our expenses, called wages. Now remember, to increase an expense, wages, it's debit, so it's debit wages. To decrease an expense, made a mistake. To decrease an asset, it's a credit, so credit bank, okay, to decrease that asset. So, like I said, assets and expenses, if we want to increase them, we use a debit, liabilities, equity, and revenue. Want to increase them, we use a credit, okay? It's just the way it is. Come over here, assets and expenses, we call them as a result debit accounts. So to increase, it's a debit, decrease, it's a credit. Now, why do we use these terms? So the accountants know what they're talking about. So if two accountants are trying to work out how to manage a transaction in the business, they can just go debit asset, credit, revenue, and they know what's happening because they know what they're trying to do there. Debit to an asset, they know they're trying to increase it. Credit to the revenue, they're also trying to increase that. Liabilities, equity, and revenue in their natural state are credits. To increase a credit account, we credit it. To decrease, we debit it, okay? Now, referring to the early example, the business paid wages of $20,000 to its employees, okay? So they paid wages, so we want to decrease the cash at bank, decrease the asset called cash. So it's going to be credit bank. We've got an expense called wages. What do we do there? Debit wages, okay, to increase that expense. The revenues are recorded in the accounting period in which they're earned, derived. Expenses are recorded in the accounting period in which they are incurred. So we call that the matching principle, okay? This makes sure that assets which have a future benefit and liabilities which have a future commitment are properly recorded. An entity therefore is able to match expenses and revenues to the correct period, and therefore we can determine whether there is a profit. So we know that this was all our revenue for the period, this was all our expenses for the period, we know that we made a profit in that period, okay? So let's have a look at a bit of an example. 30th of July 2011, we purchased inventory for resale for cash, okay? So we purchased inventory. Now that's an asset. We want to increase an asset, so that's debit inventory, but we paid cash for it, so we need to decrease that cash asset. So we're going to have credit bank. A little bit later that year, we sold all inventory for cash to the value of $10,000. It cost us $5,000. So debit bank increases our cash at bank because that's what we received. Credit revenue, that's how we record the revenue. We now have to have an account called cost of goods sold to recognize the fact that we've sold that inventory. So it's a cost of doing business. So we call that debit cost of goods sold. That's a profit and loss account, and then credit inventory. On the 15th of May, 2008, a rugby club receives a grant of $5,000 from its governing body. So they've received money, so it would be debit bank because we've received the cash, okay? Credit grant, because it's like revenue. So the grant is able to be recorded in this manner as the funds have been received, okay, and for the revenue related to the current accounting period. On the 15th of May, we said that they received this grant of $5,000. Okay, maybe we could do it this way: debit bank, credit income in advance. So this is another way of doing it. The grant is recorded as a liability. Okay, although the funds have been received, maybe we can't use them until next year, and so therefore we might have to pay them back, and so that's why we're recording them as a liability. On the 10th of August, they received a grant. The funds have not yet been received. Grants receivable in this case. So instead of debit cash, we've got debit grants receivable. It's an asset. So the funds have not been received, but the income is recognised, and so is an asset. Why is it an asset? Because that money has a future economic benefit, because when we receive the grant, we can actually use the money. Okay. Like I said, just remember, revenue minus expenses, that ends up in our income statement. Assets minus liabilities equal to equity ends up in our balance sheet. Now, one of the best ways you can learn about accounting is by doing. And so I really want you to have a go at doing those questions that I posted online for you this week as well. Like I said, keep in touch. Make sure you ask any questions. Don't forget, there's a lot of good information in the textbook. And as I said, the assignment's going to creep up on us, so let's make sure we do that. Well, thanks very much. We'll have a good day. Okay, make sure study hard. We've got a lot to get through this semester, and we'll talk to you soon. Bye.